Hello, everyone, and welcome to the Buck Stops here. I am Catherine Murray. Well, it has certainly been a very big week in the markets, continued volatility, but also a very big week as it relates to central banks. And specifically this week, the Bank of Canada raising rates by 75 basis points on Wednesday. And then today, we've also heard from the ECB raising rates by 75 basis points. The big question is whether or not these central bankers around the world, including the US Federal Reserve, are tightening too aggressively and will cause a recession. Are they tightening into a bear market, specifically in the commodities market? What does that mean? For more on where we go from here, and specifically, we're going to focus a lot on the Canadian economy and then also a few stock picks. Let's now bring in John Zechner, the chairman of John Zechner Associates. John, great to be with you. Thank you so much for joining us. Appreciate your time.
Hey, Catherine, good morning.
Good morning. And we do pre-tape this. It's a Thursday morning. And again, as I mentioned, the BOC, let's start there, raising rates by 75 basis points yesterday. There's a lot of concern that it's too aggressive, that it will cause a recession in Canada. What do you think, John? What's your takeaway?
Yeah, Catherine, that's a good point to bring up because that's a bit of the argument too. If you're saying whether the Fed will go 50 or 75 basis points at their next meeting, they've had some pretty aggressive rate hikes already. We've seen probably the most aggressive rate hikes ever when you think of the last two 75 basis point increases they did. As you say, 75 by the ECB, the Bank of Canada, 75 on top of a full point. I mean, a little over a month ago. So yeah, there is a worry maybe that if you go too fast, you drive it down the recession. Now you got to. I think the point is monetary policy, even though it's got a relatively short history, probably only back to the 70s. It does tend to work a little more quickly on in terms of a tightening rather than a loosening. The old thing, pushing on a string versus pulling kind of thing was always the sort of the vernacular that are used on that regard. But so I start to think you've already starting to see some of the impact on the housing market, some obviously on the stock market that was the most upfront. So I think you are starting to see these moves already. So it's not like you're going to have a big lagged impact that we have to worry about, down the road. I think we're seeing the impact right now. I think the bigger question is, Catherine, is what's the terminal rate? Where do they end up at? Is that going to surprise the market? I think right now in the U.S., probably in Canada as well, you're looking at a 3.75 to 4% terminal rate, and they want to get there more quickly so that then they can maybe stop, pause, and watch if the inflation data really does start to come down, and whether the economy sort of, as you brought up, maybe goes too far into reverse or slows down. So I think they want to get to a point where they can stop for a little bit and rest and watch. And that's why they're being a little bit more aggressive and front loading these rate increases a little bit more.
Yeah, I mean, they certainly do seem to be front loading it and not too worried about front loading it. To your point, it's interesting to note, though, that raising rates is almost coincident in terms of the impact or effect that it has versus loosening rates. In other words, we are seeing the effect. Don't worry too much about what the next ripple effect might be. That's, I think, kind of your takeaway. Don't worry that it's going to get a lot worse. But that is still a big unknown. And I guess my big question too is that if they're trying to fight inflation, I mean, do we not have idiosyncratic inflation? In other words, the issues that we're seeing surrounding energy and an energy crisis in Europe, just as an example, that's not going to be fixed really by monetary policy. I mean, you can have immense demand destruction, which is what the big concern is. I almost think that that's really why we're seeing oil pull back so aggressively, is the concern about global growth slowing down. I mean, you're seeing that in China with lockdowns on COVID, et cetera. But it's almost as though you've got the monetary policies here trying to fight inflation, yet you've got all these idiosyncratic aspects as to why we have inflation, and that also includes food inflation. So, what are we going to be left with?
Well, you're right, Catherine. It's the old story of control what you can control. So I think that's exactly what the Fed and the other central banks are doing right now. So certainly, by raising rates as aggressively as they're doing, they're taking the edge, as we've already seen off financial markets, particularly the stock market. That impacts savings. That's there's sort of a wealth effect that impacts consumer spending. So you slow down the consumer side. You probably slow down the services side a little bit more. As you say, you may not have any impact on food prices or oil prices because there are other factors regarding those, particularly the China shutdown and reopening again, and certainly the war in Ukraine and the impact on supply. they're controlling what they can control, and that's aggregate demand. And in the absence of being able to control those other factors, they will try to take aggregate demand down, and they're doing that by taking rates. So it's a logical response.
So, John, I just want to pick up on the approach that the BOC and the other central bankers around the world are employing, which is, really trying to curb demand. I think that you think that this is a logical approach for right now, and that maybe we'll just kind of have a bit of a wait and see. And my only concern on that front is, as they have a wait and see approach, what does that really mean for the Canadian consumer, and specifically the housing market? I mean, we know that we've had a very, very hot housing market. I'm curious, what do you think we're actually seeing in the Canadian housing market right now?
Well, clearly we're seeing a slowdown. I mean, there's a slowdown in demand, sort of buyers pull back a little bit. We start to see a bit of a move down in prices, all very logical given how, yeah, interest rate dependent and we are in Canada, how high the consumer debt levels are. So there is an impact from this, and people have to decide. So I think there's a lot of still pent up demand for services, the reopening, and other things that will keep the economy going. But I think there are edges, and we certainly the stock market and housing were the two of the edges that got most impacted and first impacted by these aggressive rate moves.
So, is there a risk, though, to the Canadian economy that we're going to really see the effect on consumers and employment from a housing market crash? Like, are we going back to the
Well,
80s, 90s?
I don't think so in that way, Catherine. In fact, the employment picture is almost opposite to typically what you see at this point in the cycle. I mean, yeah, there's going to be a little bit of scaling back, but jobs are still plentiful out there. When you look at the jobs available here in the U.S., the indicators are still pretty good. So they may cut back a little bit on, and we've seen that in the tech sector and others spots, a little bit on current hiring. But I don't think this employment market is falling apart. You haven't built up the excesses that you typically build up into this point in the cycle that would bring down a severe recession. The cycle has just been too short. It only started in the second quarter, third quarter of 2020. So we're not that deep into it. It's just they had to take the edge off these inflationary pressures a little bit, the shortage of goods, and they had to take sort of the edge off aggregate demand, which just got a little too strong in the short term. And that's what they're doing. So I think we'll moderate into a slowdown, whether technically you call it a recession. I mean, you might say already it is in the US, but because of 2 quarters of negative growth. But on the other side, when you see employment levels as strong as they are, I don't know that the NBER or the guys who classify these things would officially call this a recession. Or we won't know till after the fact. We won't know that this is well over whether this has actually been a recession. I just don't see it as being deep like we saw in 2008, 2009, or any of the ones back in the 80s.
Hmm. So, John, it's interesting with all of your decades of experience in the industry, in the financial industry. You don't sound too concerned. But I also know and believe that you are, very much a stock picker versus just kind of riding trends or riding sectors or kind of riding what's working. So maybe doing fundamental research and homework is what gives you some peace, because you can still, there's always going to be a stock that's going to do well even in a recession. So am I wrong in how you're kind of feeling about the market?
No, you want to be aware of the risk, Catherine, as you say, but you want to keep sort of a level head in this. I mean, the stock market's already come down a long way, and what's important for stocks is not is what the next move is. Like, think where we were a year ago, and at the peak of the markets, effectively, the Fed was saying inflation was going to be transitory. They weren't even thinking about raising interest rates. There wasn't much worry about economic growth. Valuations were sky high. Now, fast forward a year later, stock markets have come down a long way. We've built in a lot of interest rate increases, as I said, maybe 3.75 to 4 as a terminal rate. So you've taken a lot of the edge off of that. I still think earnings estimates have to come down somewhat, so that's a bit of a risk, depending which sectors you're in. But stocks have taken a lot of heat already. So yeah, we're sort of dusting off a lot of reports, looking at names. I mean, valuations are coming to attractive areas, and I'm looking at consumer sentiment and investor sentiment in particular, Catherine. I mean, we certainly saw that get to levels apocalyptic, I think was what they called it in mid-June from the Bank of America report, and that certainly gave you a short-term bottom, and we might soon to get to another spot like that. So I don't think, like, we're not doing any selling really in the portfolios right now. It's just a matter of when we use our cash reserves and come back in. And I'm probably getting more to a neutral weighting right now. We're not overweight, but I've seen lots of opportunities, and that's with the idea that yes, rates are probably going to three and significantly higher still, and we might get an economic slowdown or even a recession.
Okay. All right. We're going to take a quick break. When we come back, John, we'll get a few of your stock ideas that you'd be willing to put money to work into today. We'll be right back. John, I want to get your take on a couple of different areas of the market and also, stock ideas. But I want to first start with the Canadian banks because it was interesting to see them report, and when they reported an increase in their loan loss reserves, which was met by mixed reaction from a stock perspective. You would also think that in a rising rate environment, that the banks would be earning more money, and that could help propel the stocks higher. But there seems to be this overhang of concerns about their mortgages and, again, how the consumer will fare. How are you reading the results we saw from the Canadian banks?
Yeah, Catherine. I mean, don't have any Canadian banks in the portfolio right now, which is sort of rare. We sort of sold them a couple of months ago, and it's not that I have massive worries about downside for the banks from these levels. I just don't see a lot of upside. I think this last quarter sort of showed you that. I mean, a lot of what the tailwinds they had for earnings in the past 2 years are turning into headwinds. Like certainly they were taking loan loss provisions, excess loan loss provisions back into income statements. They're not doing that. They're increasing their loan loss provisions. And with an economic slowdown, those probably will increase further. Obviously, with stock markets, financial markets in general, rolling over, their capital markets activities have gone dramatically downwards. Underwritings have gone down. Trading has gone down. So, those are all problems. Yeah, there's probably a bit more of a benefit from the structure of the yield curve right now, as you say, because banks tend to borrow short and lend a little bit long. But I mean, with the curve inverting, that's sort of going to go in their face a little bit too, and they don't have the same interest rate sensitivity that they had in the past. So what it all adds up to is, yeah, I don't worry there's massive downside for them, and you're still going to get your dividend yield from them. But I just don't think there's much short-term upside. And then with TD and BMO, they've got to sort of bring in pretty big U.S. acquisitions over the next year or so, and there's always risk with doing that as well. So I'd probably gravitate towards Bank of Nova Scotia, Commerce a little bit more at these stage, where some of the risks have been taken out and the valuations are lower. But as I said, right now there's other areas of the market where I think there's probably better upside if we get a bounce.
What other areas within the Canadian market do you think offer better opportunities?
Well, I still think you want to stick with the energy trade. I mean, we're getting a little late, and it always bothers me that now, with 2 years ago, people wouldn't touch energy. Now everybody comes on and they say, that's the only sector, and you got to believe in it right now. It's a lot of money is piling in, and I don't sort of like that, but it's hard to argue with the valuation. When you talk about 20-25% free cash flow yields trading at three times operating cash flow, and I just don't really see a break in the oil price coming forward in the short term, even though it's come off the boil a little bit recently. I mean, the U.S. has sort of used up the SPR. China's coming back on with more demand. You haven't settled any of the problems with Russia and Ukraine right now, and there is somewhat of a fundamental, shortage in the supply of oil. So that's going to keep prices in these range. And these companies kick out a lot of cash at those levels. So I'm more into the oil levered companies. Where I'd probably be a little bit more cautious short term is natural gas. I mean, there's really in North America, there's no fundamental shortage of natural gas. There's problem of obviously getting it to Europe right now. We don't have the access to, the pipelines or the LNG facilities really to move it to those markets, so we can never benefit from it. And you still could, kick off a lot of excess gas in shale production and other things. So it's, I don't think gas prices are going to sustain anywhere near where they are. So, the pure gas levered companies like Tourmaline to a degree, ARC, Birchcliff, Pado, I'd be a little bit more reticent on those as opposed to the oil levered companies like, Cenovus, Suncor, Crescent Point, Whitecap, names like those.
Hmm. Yeah, it's interesting. I do feel that even though we've seen the price of WTI pull back quite dramatically, the fundamental structural reason to still be long oil to me is still very much there. And it's interesting to see the new UK Prime Minister lift the ban on fracking today.
Yeah, those supply constraints are going out the window in the short term to get these supplies in, and they're doing everything they can. And in the end, you're getting a better response. And but like in the short term, with demand probably coming back from China now, and no resolution anywhere in sight in Ukraine. Yeah, it's still going to be squeezed for a period of time. And while it does, these guys kick a lot of excess cash that they are suddenly more shareholder friendly about, and handing back, whether it's through buybacks or increased dividends or whatever.
Yeah, a couple of special dividends. So still go long Synovus in Canada, maybe lighten up on some of the gassier names here. We're going to take a quick break, and when we come back, we're going to get a few more stock ideas from John Zechner, and specifically perhaps a couple of U.S. ideas. We'll be right back. Hi, John. I want to talk and continue to talk about the U.S. stocks that you might be interested in. And one of them is Amazon. What's the story there for you?
I think for Amazon, Catherine, it's the certainly the combination of the businesses they're in, and sort of the discount that we're getting right now in the current stock price, especially given the way it's coming off the highs recently and the cash generation they have, but particularly the Amazon Web Services, the cloud business. I mean, I still think that's a big growing component. I think companies generally, even companies like ourselves included, are moving to cloud-based services rather than having their own servers in the back room, and they are the dominant player there. They're growing. Microsoft and Alphabet are sort of the number two and three players in the industry. They're really dominating. This will continue to grow through periods of time. The other thing Amazon is doing well is they're doing like Apple did, is sort of migrating services onto a platform and selling the platform. When you look at right now from Amazon, I mean, when you can get your Prime services, you become a Prime member, you get to the Prime Video, which is almost like a Netflix in itself. You obviously get the delivery services, and you can sort of extend on that. So what they're doing is really packaging together with home security and other things, and they'll continue to build on that. They're generating enough cash to have these growth programs in place, and the valuations have come down to more reasonable levels. They're generating that cash, and they can decide now whether they want to generate more, or whether they want to sort of give some back to shareholders, or just migrate, take that in. So it's I think it's a really good story, and the stocks come down. We haven't owned it before, and we've added in this recent weakness.
And John, why do you think the stock has seen such significant weakness? Do you think it's just, you know, down with the rest of the market, and of course the concern regarding higher rates putting pressures on valuations, and maybe even concerns surrounding the consumer, and therefore obviously the sales on Amazon? Is that what it is, or is there something else?
It's a big stock impact, Catherine, too, because you look at Apple, you look how dominant sort of the five biggest tech stocks were in the S&P 500 and the Nasdaq, and the index players have probably kept these things in better, because they haven't fallen as much when you look at it compared to a lot of the rest of the tech stocks. So yeah, they're down, but they're not like down to 60, 70, 80% we've seen in sort of some other areas, and even some of the 50% drops we've seen in the chip stocks. So I think indexing has probably kept them in the game a little bit more, and people have gravitated towards larger players, dominant players. We've sort of seen that they sort of accrue the gains within the industry. They buy up the smaller competitors, they buy the apps. So the big players continue to be in a very good position, and they'll continue to get a premium multiple. It sort of reminds me of, like, Coke in the 80s and 90s, or the drug company or something like that. They're dominant players, and they ended up with premium multiples, and they kept them for longer periods of time.
Okay. What one other name that you like is Disney. What's the story there for you?
Well, it's interesting. I mean, the stock down 50% from the peak, and I started looking at what the research reports were saying, and what was 100% higher than it is now. And quite honestly, I mean, nobody does cross-selling better than Disney. When okay, they take a property like a movie and they turn it into a ride at the park, they turn it into a game, they turn it into a video, they turn it into a TV series. They do this so well, and they've got this depth of library, and certainly what they did with the Marvel, with the Lucasfilm friends, with the Fox asset they bought. Now they're sort of putting that all into play, and they've added streaming to it, and they've got such a good library for streaming. I mean, we've got all the services at our place right now, and if I sort of push came to shove, and I said, okay, we're going to drop all but one, I know the vote would be keep Disney. So it's I think they've done well. The parks are doing exceptionally well. I mean, the numbers coming out of the park, even post pandemic, just surprising me. Even though the numbers aren't back to where they were in terms of the number of people, the margins and pricing are very strong. So add it all up, it's a great story. It's come down a long way. It's just a classic, probably one of the best growth assets in the U.S. over the last 6 decades, and then now you're getting it 50% down from where it was. So it's I like to take opportunities like that. So
Yeah, I guess people are a little bit concerned though about the consumer impact, recession, etc., weighing on Disney shares.
yeah, there's always that risk. I mean, the high-end vacations are going to take a hit, and that's any risk in a downturn. You'll see that with Disney or any other sort of consumer product, sort of the services side. But I think there's a lot of backlog activity, and like I say, with Disney now, I mean, there's so many ways they can sell the product, and going
Yeah,
into the streaming side, makes them an at-home play as well. And then you had sports and all the other packages they have. If content drives this, nobody has better content than Disney at this stage. So.
yeah. And people with the pandemic, everybody wants to go back to Disneyland and Disney World. John, we're going to leave it there. Thank you so much for your time, and thank you everybody for watching as well. Stay tuned for much more on the Buck Stops here.